S&P futures are up, what, 1.2%, Dow futures are up 0.9%, and Nasdaq futures are just screaming higher by 1.97% in the overnight session.
Yeah, it is Monday morning, June 15, 2026,
Yeah.
and the implied open is pointing to a massive, risk-on gap and go.
Right, but before you start chasing this pre-market euphoria, we really have to pause and ask the multi-trillion-dollar question. I mean, are we staring at a genuine structural breakout?
Or is it just the most elaborate liquidity trap of the year waiting to spring the second the opening bell rings?
Exactly.
Because when you see pre-market volume moving this aggressively on geopolitical headlines, the mechanical flow underneath the surface is, well, it's usually setting up to blindside the retail crowd.
Right. You can't just read the news today. You have to calculate the mechanical forced buying and selling that those headlines trigger across all the institutional algorithms.
Yeah, absolutely.
Okay, let's unpack this. Because for today's deep dive, we're pulling from an exclusive stack of pre-market data feeds and strategy notes from Bulls, Bears, and the Bell, Global Market Strategy Daily.
Which is exactly what you need on a morning like this.
Yeah, and our mission today is to decode the chaos of this overnight session for you. We're going to strip away the flashy headlines, look at the underlying market plumbing, and really arm you with the exact lines in the sand the big institutional players are watching.
Because that overnight catalyst driving the tape is, it's nothing short of a geopolitical earthquake.
It really is. Over the weekend, President Donald Trump announced a tentative U.S. Iran peace agreement.
Right. And setting aside the politics entirely, just looking at this purely as a market catalyst, it officially ends a 100-day conflict and reopens the critical Strait of Hormuz.
Which immediately triggers a massive repricing of global risk. The Strait of Hormuz is the global economy's most sensitive choke point for energy transport.
Exactly. The moment the news broke that the waterway was cleared, the energy risk premium just completely evaporated.
Yeah, oil collapsed. Brent crude crashed 4.7%, down to roughly $83 a barrel. And WTI crude fell over 5% to around $80.43.
And those ripple effects hit the bond market instantly.
Oh, right away. The 10-year Treasury yield slipped nearly 5 basis points to about 4.44%, and the U.S. dollar index, the DXY, hit a 10-day low near 99.50.
What's fascinating here is how the unraveling of that energy premium creates this mechanical tsunami of capital flowing straight into the technology sector.
Right, because of portfolio positioning?
Exactly. Think about the positioning over the last 100 days. When a conflict threatens energy supplies, institutional managers build massive defensive hedges, right? They buy oil futures, energy equities, just to protect against an inflation spike.
And the second piece is announced, those defensive hedges become completely dead weight.
Yeah, capital aggressively unwinds out of energy and rotates right back into high beta growth assets.
And for anyone modeling this out, high beta just means we're looking at stocks that move with amplified velocity relative to the broader index, which usually means mega cap tech.
Oh, completely.
I look at the Nasdaq futures surging almost 2% this morning, and it honestly reminds me of a marathon runner who has been forced to carry a 50-pound backpack for the last 3 months.
Right, and suddenly you cut the straps.
Yeah, the heavy backpack drops and the runner just sprints. It's a pure, instantaneous relief rally.
And the math behind that relief rally is actually twofold. First, you have that sudden drop in yields we mentioned.
Right.
Lower yields act like a sudden drop in the denominator of a discounted cash flow model. So when the discount rate goes down, the present value of future tech earnings automatically expands.
It's just a mechanical valuation boost.
Exactly.
Yeah.
And second, you have the weaker dollar. A sub-100 DXY instantly juices the overseas translation revenues for these multinational tech giants.
Oh, because if a massive software company is selling enterprise licenses in Europe or Asia, those foreign currencies are suddenly worth more when converted back to U.S. dollars on the quarterly balance sheet.
Yeah, the macro pressure valve has been completely released.
Which sets up the perfect gap-and-go scenario for tech bulls today. But, and this is but if we look at the timeline, there's a massive temporal collision happening tomorrow that completely threatens this narrative.
The Fed.
Yes, the market is popping champagne over the oil drop today, but the Federal Reserve is waiting in the wings Tomorrow begins their two-day meeting leading right into Wednesday's interest rate decision.
And institutional desks are hyper-aware that this is not just a standard run-of-the-mill policy update. This is Kevin Warsh's first FOMC meeting as the new Fed chair.
Right, and he's stepping into the driver's seat immediately following a May CPI print that came in uncomfortably hot at 4.2%.
Yeah, that inflation read is not something a brand new Fed chair can easily wave away with a dovish tone, even with oil cooling off over the weekend.
So Warsh is widely anticipated to bring a pretty hawkish mandate to the table to establish his credibility. Let me play devil's advocate for a second, though. Using the standard retail trading playbook. The classic assumption goes like this. If interest rates and yields spike later this week, because Warsh comes out hawkish, retail investors assume they should immediately sell their expensive technology stocks and rotate into cheap value stocks.
Right.
Does that textbook logic still hold up in today's tape?
It fails miserably. And relying on that outdated playbook is exactly how retail traders get destroyed by what the institutional desks call the pain trade.
Walk us through the mechanics of that pain trade, because the structure of these companies has, fundamentally changed.
We have to look at the cash fortress paradox. The mega-cap technology companies, the massive winners of the AI cycle over the last few years, they no longer operate like traditional speculative growth stocks that need to constantly borrow cheap money to survive.
Right, they aren't borrowing at all.
No, they actually function more like highly rated sovereign bonds on steroids.
Let me stop you there, because the math on that fortress is staggering. They aren't just sitting on idle cash, they are actively yielding on it.
Exactly. They generate tens of billions in free cash flow and park it in short-term treasury instruments and money market funds. So when the Fed raises interest rates, or keeps them elevated, these specific mega-cap companies actually earn significantly more interest income on their cash fortresses.
So the higher rates go, the more free money they basically print from their balance sheets.
Yeah. So retail traders aggressively short tech ahead of a hawkish Fed, thinking higher rates will crush the sector, and they just get squeezed because these cash giants stubbornly refuse to drop. Their fundamentals actually improve with higher yields.
But wait, if they are essentially immune or even mathematically benefiting from higher rates, why do we still see tech violently flush downward sometimes when bond yields spike?
Because of the secondary layer of the market plumbing. It's called the liquidity basis trap. It has absolutely nothing to do with the fundamentals of the technology companies and everything to do with hedge fund leverage.
Break down the leverage on that basis trade, because that is where the plumbing actually breaks, isn't it?
Yeah, hedge funds exploit these tiny fractional arbitrage spreads between cash treasuries and treasury futures. And because the profit margins on those spreads are microscopic, the funds have to lever up 50 to 1 or even 100 to 1 to make the trade worthwhile.
Oh, wow.
So if Kevin Warsh comes out on Wednesday and yields spike violently, the clearinghouses immediately demand massive margin calls on those levered bond positions. The broker calls the hedge fund and demands billions of dollars in cash within hours.
And when a fund needs to raise billions in cash that fast, they can't sell their illiquid small-cap value stocks. There simply aren't enough buyers on the bid to absorb that volume without crashing the price.
Right. So they hit the sell-all button on their most liquid, highly appreciated assets. They dump mega-cap tech.
Which means the stock drops not because the underlying business is struggling, but simply because it's acting as a forced ATM withdrawal for an over-leveraged bond fund.
Exactly. And this sudden, massive sell-off for cash catches the retail longs completely off guard.
So it's an ATM withdrawal, not a fundamental sell-off, which really means you cannot just blindly buy today's geopolitical relief rally without keeping one eye locked on the bond market and Kevin Warsh on Wednesday.
Definitely.
But speaking of market plumbing breaking, there is a purely structural hazard happening on the trading floor today that you need to navigate. Today is CME Rollover Day.
Ah, yes. The transition of the front-month futures.
For those navigating the tape today, the market is officially transitioning its volume from the June 2026 contracts, the M26 series, to the September 2026 contracts, the U26 series. And this is happening across the S&P 500 and the Nasdaq 100.
Right. So institutions have to close out their expiring June futures and simultaneously open new positions in the September contracts. That means the order book is effectively splitting its liquidity. The entire mathematical landscape of the market is shifting right under your feet.
It's like you're driving 80 miles an hour trying to merge onto a busy, chaotic highway, and your GPS suddenly resets and recalibrates all the distances.
That's a great way to put it.
Because if your charting platform hasn't been updated and is still feeding you data from the June contracts, your technical levels are completely misaligned. The old map will lead you straight into a ditch because the liquidity in those June contracts is deteriorating by the minute.
So we had to give them the updated map. Let's look at the exact lines in the sand from the strategy notes.
Okay, starting with the S&P 500, looking at the new September ESU 26 contract. Resistance is sitting heavily at 7,600. The institutional notes flag this specifically as a major options gamma wall.
Gamma wall, yeah.
Now, I want to drill into that term. A lot of traders see gamma wall and just think heavy resistance. But what is the actual market maker behavior happening around that 7,600 level?
It all comes down to delta hedging. Options dealers have sold a massive, disproportionate amount of call options at that 7,600 strike price. As the index price organically rises and approaches 7,600, the dealer's risk exposure, their delta, changes exponentially.
Right.
So to stay market neutral and avoid catastrophic losses, the algorithmic risk models force these dealers to sell the underlying S&P index futures as the price moves higher. This forced selling creates an artificial magnetic ceiling.
It's incredibly difficult for the market to push through a gamma wall on the first attempt because the dealers are mechanically dumping supply onto the tape just to hedge their own books.
Exactly.
And looking at the downside for the September S&P, support is identified in the 7,500 to 7,520 gap fill zone. But if your screens are still stuck on the old June ESM 26 contract, it's showing support way down at 7,430 to 7,435. That is a massive mathematical discrepancy.
I mean, anyone trading off those June numbers today is flying blind into a wood chipper.
Yeah. Moving over to the Nasdaq 100, the September NQU 26 contract shows resistance sitting at 30,500. Support is located at the 30,000 to 3,100 psychological level. Again, you are looking at the June NQU 26 contract. It shows support way down at 29,662.
The structure we're dealing with today is a genuine macro breakout driven by the Middle East geopolitics, but it is masked entirely inside a short-term rollover liquidity trap.
A breakout masked inside a trap.
Because the volume is actively splitting between June and September, the order books on both sides are thinner than usual. That lack of dense liquidity causes erratic spreads.
You'll see violent price spikes that look like confirmed breakouts, only for the price to immediately reverse because there wasn't enough real institutional volume layered behind the move to actually sustain it.
Yeah, the golden rule for you today: do not chase the opening bell gap. Let the volume settle into the September contracts.
You really don't want to be the retail trader providing exit liquidity for a high-frequency algorithm during the first hour of trading.
No, you do not.
So we have the macro tape mapped out. We have the rollover lines in the sand defined. Let's map out the pre-market volume and look at the specific mega movers that are setting the implied open today. We have to start with the absolute elephant in the room.
SpaceX, ticker SPCX.
The historic $75 billion IPO. Yeah. It priced at $135 a share on Friday, surged 19% during its first session to close at $160.95, and officially passed a $2 trillion valuation on day one.
Unbelievable.
And pre-market this morning, the tape is lighting up. It's screaming over 170. The fundamental catalysts are stacking up quickly. Over the weekend, Elon Musk forecasted $1 trillion in revenue by 2030 in a post on X.
Right.
We also have a brand new 2X leveraged ETF, ticker CESPX, launching today specifically to capture the intraday volatility. But the real institutional flow story here is the passive index inclusion rule.
Yeah, if we connect this to the bigger picture, this is where the mechanics of modern markets get truly chaotic. Because SpaceX instantly became a $2 trillion public company, passive index trackers like the Nasdaq 100 and the Russell indices are mechanically forced to include it in their portfolios.
They don't have a choice.
None. The bulls, bears, and the bell notes estimate that these passive funds have to blindly buy between $22 and $27 billion of the stock to rebalance.
Here's where it gets really interesting, though. You have passive index funds being literally forced by their own mathematical rules to blindly buy billions of dollars of SpaceX today. But the fundamental desks are looking at the company's balance sheet, which booked a massive $4.94 billion net loss in 2025.
Right.
So you have a spectacular tension between mechanical flow and fundamental reality.
Well, on the bull side of the tape, you have this relentless, forced buying pressure targeting a gamma squeeze up to $180 or even $200. The passive algorithms don't care about a $5 billion net loss. They don't run fundamental analysis. They simply execute the buy orders to track the designated index weight.
But on the bear side, the fundamental active managers are eyeing that $135 IPO price as the ultimate reality check support level, driven by the reality of those massive capital expenditures and net losses.
Exactly. We are witnessing the raw power of mechanical flow. And keep in mind, to buy $27 billion of SpaceX, those index funds have to raise $27 billion in cash.
Wait, so they are mathematically forced to trim their holdings in other mega caps to make room?
Yes. So beneath this surging index level, there is a massive, invisible structural reshuffle happening that you won't see if you only look at the top-line S&P number.
It's an invisible liquidation event underneath the surface. All right, looking at the next major pre-market gapper, Micron Technology, ticker MU. They are leading the AI chip rally pre-market, currently trading near $982.
Micron is a fascinating real-time study in supply chain bottlenecks. The research notes highlight that their 2026 high-bandwidth memory, or HBM capacity, is already 100% sold out.
Wow, every single chip they have the capacity to manufacture this year is already spoken for. Let's actually look at the mechanism of that HBM bottleneck, because it's not just that the chips are popular.
No, high-bandwidth memory is structurally incredibly complex to manufacture. It requires stacking memory chips vertically, and the yield rates, meaning the percentage of chips that actually pass quality control, are notoriously low across the industry.
Okay, so supply is tight by default.
Yeah, and because the 2026 supply is completely locked up by hyperscalers, Micron possesses ultimate pricing power. Desks are aggressively front-running their June 24 earnings date because they're modeling a massive margin expansion that the broader street simply hasn't fully priced into the stock yet.
For the technical levels on Micron, bulls are targeting resistance at 995.87, aiming to use this pre-market volume to push past the psychological $1,000 mark. The bear floor is sitting firmly at 935.89.
Yep.
Moving from silicon to asphalt, we have Ferrari NV, ticker AACE. Morgan Stanley just upgraded them to overweight this morning with a price target of €380, which translates to about $408.
Ferrari is staging a recovery from a fairly brutal 26% sell-off over the past year.
Yeah, that sell-off was driven by heavy EV skepticism surrounding the launch of their new €550,000 electric vehicle, the Ferrari Luce. But they're already up 4.4% in early Milan trading.
Right.
Now, Morgan Stanley isn't just saying, oh, it's a Ferrari, wealthy people will buy it anyway. They're specifically modeling something called terminal brand confidence.
Consider the Veblen good dynamics at play here. In a high-rate macroeconomic environment where the middle-class and upper-middle-class consumer is feeling the squeeze of inflation, Ferrari operates with near-total price inelasticity.
Because their buyers aren't affected by rate hikes?
Exactly. Terminal brand confidence means their future cash flows are so secure and decoupled from standard economic cycles that they actually model more like a sovereign bond than an automaker.
Which is wild for a car company.
Yeah, the sell-side model is suggesting that the shift to an EV powertrain doesn't degrade the brand's pricing power one bit. The previous 26% sell-off was just a fundamental mispricing of that inelasticity.
For the levels on Ferrari, the bull case requires clearing $370 in the U.S. cash session today, while the bear floor is looking at $345.59, or potentially gapping all the way down to $312.51 if the EV narrative sours again.
It is a target-rich environment today. I mean, there are massive opportunities on both sides of the tape, but the overarching theme really must be discipline.
And real quick, just some other pre-market movers. Comtech, ticker CMTL, is up over 5% on a $157.5 million space unit sale to Galat. And Powerfleet, ticker AIOT, is up on an 11% revenue jump and a new $120 million South African Treasury deal.
So much flowing through the tape today.
Let's summarize the mission for you as you stare down the opening bell. The geopolitical relief valve in the Middle East has released a massive wave of tech euphoria. The 50-pound backpack has been dropped.
But the market plumbing, specifically the CME rollover degrading front-month liquidity and the forced blind index buying of SpaceX, means the terrain under your feet is actively shifting.
You must execute with tactical patience today. Do not let FOMO push you into a rollover liquidity trap during the first hour of trading.
Right. Keep your position sizes conservative ahead of Kevin Warsh's Wednesday Fed decision.
Yeah, let the morning volatility and those erratic spreads settle down. Watch those September contract support bands like a hawk, 7,500 on the S&P and 30,100 on the Nasdaq. Now, before we sign off, I want to leave you with one final thought to mull over as you watch the tape today.
Go for it.
We talked about SpaceX, a company that lost nearly $5 billion last year, and how passive index trackers are mechanically forced to pour up to $27 billion into its stock simply because it went public at a $2 trillion valuation.
It really exposes a massive contradiction in how capital is allocated.
It does. It raises a profound question about the very nature of price discovery in our markets today. Who is actually setting the price of modern innovation?
Is it the free market's genuine, fundamental belief in the underlying technology and its future profitability?
Or has true price discovery been completely hijacked by the blind robotic algorithms of passive index rebalancing? Keep your eyes on the tape, navigate the rollover carefully, and we will see you next time.